everyone, welcome back to holisticinvestment.in, where we simplify the world of personal finance for individual investors like you. Today we are diving into a debate that every investor faces at some point. Should you aim for perfection in investing, or is consistency the real key to success? Most people dream of timing the market perfectly, picking the best stocks or investing at the right moment. But does that actually lead to wealth? Or is it the small, regular, disciplined actions that compound into real success over time? By the end of this video, you will know why chasing perfection in investing can backfire, how consistency builds wealth even with small investment, the real life examples that prove which approach wins in the long run. And of course, I will share practical solutions to help you become a consistent investor starting today. Let's get into the video. So what does perfection in investing look like? So what does it mean to be a perfect investor? Most people think it's about buying at the lowest price and selling at the peak, picking the best performing stocks or mutual funds every year, avoiding losses completely. Sounds amazing, right? But here's a problem. Perfection is impossible. Even the best investors in the world can't predict the market 100% of the time. Example, Warren Buffett, a famous investor, doesn't chase perfect market timing. He focused on long-term value investing, and even expert fund managers can't always beat the market. So trying to be perfect in investing is like trying to win every bet at a casino. It just doesn't happen, and that brings us to our next point. Why trying to be perfect can backfire. Chasing perfection can actually hurt your investing journey in three major ways. Number one, fear of investing at the wrong time. You wait for the perfect time to invest, but guess what? That time never comes. Meanwhile, your money is sitting idle, losing value to inflation. Number two, over trading and emotional decisions. When you try to predict market highs and lows, you end up buying and selling too often. More trades is equal to higher taxes, and transaction fees is equal to lower returns. Number three, panic selling during market crashes. If you aim for perfection, market dips feel like failures, you sell in panic instead of staying invested for the long run. So the lesson, perfect investing is a myth. Consistency is what builds wealth. So next comes the point, the power of consistency. Small steps, big results. So consistency in investing is like going to the gym. If you work out once a year for 5 hours, will you get fit? No. But if you exercise for 30 minutes every day, over time you see real results. It's the same with investing. Small regular investment, even like 500 rupees per month, can grow into huge wealth over time. Consistency allows you to smooth out market fluctuations. Example, imagine investing 5,000 rupees every month in an index fund for 20 years. Even if the market goes up and down, your money keeps growing. This approach beats someone who waits years for the perfect moment. So let's break it down. Imagine two investors, Amit and Rahul. So Amit is obsessed with timing the market. He spends hours analyzing charts, reading financial news, and waiting for the perfect moment to invest. He believes that one great investment will make him rich. But guess what? He keeps waiting. 1 month turns into 6, and 6 months turn into years. When he finally decides to invest, he second guesses himself every time the market dips, panics, and pulls out his money too soon. Rahul, on the other hand, takes a different approach. He doesn't try to predict the perfect time. Instead, he invests a fixed amount every month, no matter what the market is doing. Some months the market is up, some months it's down. But over time, his money grows steadily. So who wins in the long run? Rahul. The winner is consistency. So by the time Amit finally invests, Rahul has already built wealth through years of steady investing. The market rewards patience, not hesitation. Now let's talk about why consistency is so powerful. Compounding. Compounding is often called the eighth wonder of the world because it allows your money to grow exponentially over time. Here's how it works. You invest money, your money earns returns, those returns get reinvested, and they generate even more returns. This cycle continues, snowballing your wealth. Example, imagine two investors, Meera and Suresh. Meera invests 10,000 rupees once and leaves it for 20 years at a 12% return. Her final amount, 96,500. Suresh, on the other hand, invest 10,000 rupees every year for 20 years at 12% return. His final amount 70 plus lakh. Why? Because compounding rewards time, not perfection. Lesson: the longer you stay invested, the bigger your wealth grows. Waiting for the perfect moment means you miss out on years of compounding. Start now, stay consistent, and let compounding do the heavy lifting. Want to know how to build an investing habit that lasts? Keep watching. So, how to build an investing habit that lasts? Now that we know consistency beats perfection, let's dive deeper into how you can actually build a long term investing habit. Most people struggle with consistency not because they don't want to invest, but because they don't have a structured system in place. So, let's go step by step and explore practical solutions that will help you make investing a regular part of your life. Solution 1: set up a systematic investment plan SIP for discipline. A systematic investment plan is one of the simplest ways to stay consistent in investing. But why does it work so well? SIPs remove emotions from investing. You don't have to think, analyze, or stress about market timing. They work on autopilot. You decide an amount, a date, and your bank automatically transfer money into your chosen mutual fund. SIPs use rupee cost averaging, meaning when markets are down, you get more units. When markets are up, you get fewer units. Over time, this balances out your cost. So the pro tip is choose a date right after your salary credit date so you don't get tempted to spend the money elsewhere. Example, you start a 5,000 rupees monthly SIP in an index fund. Even if the market crashes, your SIP continues and you accumulate more units at lower prices. Over 10 to 15 years, these small investments compound into lakhs or even crores. So the lesson is SIP is equal to consistency without effort. Now the solution 2. So second solution is small steps towards your goal. Use a systematic transfer plan, which is an STP. What if you have a lump sum but are afraid of investing it all at once? That's where systematic transfer plan STP come in. So STPs gradually move your money from a low risk fund like a liquid fund to an equity mutual fund. This spreads your investment over time, reducing the risk of investing at a bad market moment. Example, you have 2 lakhs to invest. Instead of putting it all in stocks at once, you put it in a liquid fund and start an STP. Every month, 10,000 rupees is transferred from the liquid fund to an equity mutual fund. This way, you reduce risk while still investing regularly. So the lesson is, if you fear market timing, use STP for a smooth transition. Third solution, SIP top up, the power of gradual increases. Sticking to the same SIP amount forever might not be the best strategy. Instead, as your income increases, your investment should grow too. That's where SIP top ups comes in. SIP top ups allow you to increase your investment amount at a fixed interval, say every year. So even a 5% increase per year makes a huge impact over time. Example, you start with a 5,000 rupees SIP. Every time you increase it by 500 rupees, just like 10%, in 10 years your SIP is 10,000 rupees per month. The best part, you won't even feel the difference, but your portfolio will grow massively. So the lesson here is SIP top-ups, the easiest way to grow your wealth. Now let's take a look at the solution number 4. Automate and track your progress regularly. One reason people fail at investing consistently is lack of tracking. What gets measured gets improved. Here's how to stay on top of your investments without getting overwhelmed. Set a calendar reminder every 6 months to review your portfolio. Don't check daily. Investing is a long-term game. So use an investment tracker app to see your progress. Rebalance if needed. If one asset class grows too much, shift some money to maintain balance. Now the example here is, if your equity allocation grows too much and your portfolio becomes too risky, you shift some money to debt funds or gold. This keeps your portfolio aligned with your goals. So the lesson is, investing is like a garden. Check in regularly but don't overwater. Now, to truly understand the power of consistency versus perfection, let's compare two investors with real life example. Like number one is Raj, who chases perfection. He always tries to time the market. He reads news, watches stock trends, waits for the right moment. In 10 years, he invests only 3 times because he kept waiting for the perfect price. Misses out on major bull runs because he was too scared to enter. Here comes Priya, who is a consistent investor. She invests 5,000 rupees every month through all markets ups and downs. Doesn't worry about market timing, just stays invested. Uses SIPs, top ups, and rebalancing wisely. After 10 years, her portfolio has grown significantly because of compounding and regular investment. So, who wins? Priya. Raj may have bought at good prices sometimes, but since he invested very little overall, his wealth is much lower. Priya benefited from compounding and averaged out her cost over time. So the lesson is regular investing beats market timing always. So while consistency is key, you also need smart strategies to manage risk. First of all, diversify across asset classes. Don't put all your money into just one type of investment. Balance your portfolio between stocks, bonds, gold, and real estate. Another thing is avoid speculative investment. Don't chase quick rich schemes like penny stocks, F&O trading, or crypto gambling. Stick to strong, proven investments and also increase your investment as income grows. So, as your salary grows, your investment percentage should also rise. Start with 20% of income, increase to 30% or more over time. The lesson here is consistency doesn't mean blindly investing. It means regularly making smart choices. Even with all this knowledge, sticking to a long term plan isn't easy. That's where a financial expert can make a huge difference. A good financial planner helps you avoid emotional mistakes like panic selling, over trading, etc. And it helps you to stay aligned with your long term goals like retirement, house purchase, etc. and make portfolio adjustments as needed like rebalancing and tax efficiency. Investing isn't just about numbers, it's about habits, discipline, and long term investing. So, what is the final takeaway? The secret to wealth isn't in market timing, it's in time in the market. So, consistency builds wealth, perfection leads to procrastination. A simple SIP beats years of overthinking. So, start small, stay consistent, and watch your wealth grow. If you found this video valuable, hit like and subscribe for more investing insights. So the question for you is, are you a consistent investor or do you still wait for the perfect moment? Drop your thoughts in the comments, and if you need personalized professional guidance from a certified financial planner for your investment and financial decisions, then click the link in the description to register for a free consultation today. Thank you for watching.
Can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.